Banks are quietly killing car loans. Nobody noticed who replaced them. Here are the 5 things you need to know about the war for your car payment, and number 1 will change how you see this entirely. Number 5. Americans now owe $1.63 trillion in auto debt. That number from the Federal Reserve's Q1 2026 report is an all-time record. The average new car loan payment hit $748 a month in March 2026, according to Edmunds. That's up 11% from just 2 years ago. But here's the part nobody is talking about. Delinquencies on subprime auto loans, borrowers with credit scores below 620, crossed 6.4% in February 2026. That's the highest level since 2009. The people who can least afford these payments are falling behind fastest, and the institutions holding that paper are about to feel it. Number 4. For decades, the car finance game had 3 players. Big banks like JP Morgan Chase and Bank of America, captive lenders owned by automakers, think GM Financial and Toyota Motor Credit, and credit unions picking up the scraps. That power structure held for 40 years, but starting in late 2024, the banks started pulling back. JP Morgan cut its auto loan originations by 19% between Q3 2024 and Q4 2025. Bank of America reduced its auto book by $14 billion in the same window. Why? Because the risk-adjusted returns collapsed. When your borrowers are defaulting at 2009 levels and your cost of capital is still elevated from the Fed holding rates at 4.25%, the math stops working. The banks didn't announce this retreat. They just quietly stopped saying yes. Number 3. Into that vacuum stepped the most aggressive player nobody expected, Tesla Capital. In January 2026, Tesla launched its own in-house lending arm across all 50 states, offering 2.99% APR on Model 3 and Model Y purchases. That's a full 280 basis points below the national average for new car loans. Elon Musk said on the Q4 2025 earnings call, and I quote, "We don't need to make money on the loan. We need to make money on the car, the software, and the insurance." That single sentence is the entire strategy. Tesla is subsidizing cheap financing to lock customers into its ecosystem. Full self-driving subscriptions at $199 a month, Tesla insurance, supercharger revenue, over-the-air upgrades. The loan is just the hook, and it's working. Tesla's U.S. deliveries jumped 23% in Q1 2026 compared to Q1 2025. Meanwhile, Ford Motor Credit reported a $312 million loss in Q4 2025 because it couldn't match those rates without bleeding cash. GM Financial's delinquency rate hit 4.1% in March 2026. The legacy captive lenders are getting squeezed from both sides, banks retreating above them, Tesla undercutting below them. Number 2. The ripple effects are already spreading. Ally Financial, the largest independent auto lender in the United States, saw its stock drop 18% between January and March 2026. Their auto loan portfolio of $109 billion is now carrying the highest charge-off rate since the company emerged from the old GMAC bankruptcy. Credit Suisse, or what's left of it inside UBS, downgraded the entire auto ABS sector in February 2026, warning that the securitized bundles of car loans sold to pension funds and insurance companies could see losses exceed initial projections by 30 to 40%. If that sounds familiar, it should. These are the same mechanics that turned mortgage-backed securities into a financial crisis in 2008. Nobody is saying auto ABS will crash the global economy. But a $1.63 trillion market repricing risk in real time absolutely will create winners and losers, and fast. Number 1. So who makes money here, and what do you actually do? Let's follow the money. Sell or avoid Ally Financial. Their exposure is too concentrated and their margins are compressing every quarter. The stock traded at $32 in January. It's at $26 today. Analysts at Morgan Stanley have a price target of $21 by year-end 2026. Avoid Ford stock as long as Ford Motor Credit keeps hemorrhaging cash. That lending arm represented 26% of Ford's total profit in 2023, and now it's a drag. Wait on GM. Their lending book is stressed, but their EV transition and partnership with Honda gives them optionality. The real buy signal? Tesla. Not because the cars are better, because Tesla just turned itself into a fintech company that happens to sell vehicles. Every loan it originates feeds data into its insurance model, which feeds its autonomous driving program, which feeds recurring software revenue. Morgan Stanley's Adam Jonas raised his Tesla price target to $465 in March 2026, specifically because of the lending and insurance flywheel. The other buy? SoFi Technologies. As banks pull out of auto lending, SoFi has been quietly expanding its auto refi product. Their auto loan originations grew 41% year over year in Q1 2026. They're picking up the prime borrowers the banks are abandoning. Here's the bottom line. The car on your driveway is no longer just transportation. It's the center of a $1.63 trillion financial war, and the power just shifted from Wall Street banks to Silicon Valley platforms. The window to position around this is right now, before the next round of earnings in 3 weeks forces the market to reprice. This could move very fast. Follow the money with us. Like and subscribe for daily intelligence.